Hello, Tuesday's World News. And we're going to start with pink pics from FT Alphaville advertising articles in the Financial Times. Wolfgang Munchau is the first one with "Don't blame Moody's for a messy euro crisis." I'll read it because I think this is the first of our real macro potential problems, which there are three. You can always gauge the temperature of the Eurozone crisis by the blame game, writes FT commentator. Last week the cacophony briefly subsided when everybody who mattered accused the rating agencies of engaging in an anti-European conspiracy. This was the day after Moody's downgraded Portugal to junk. The fury of the reaction tells me that the process is in real trouble once again. The most interesting aspect of Moody's rating was not the downgrade itself, but the reasoning. Moody's expects that Portugal, like Greece, will need another loan. Moody's also expects that the politics will be just as messy. Will not the Germans again seek private sector participation as a condition? Of course they will. Moody's concluded, rightly in my view, that the messy European Union politics constitutes a reason for concern. Having observed this crisis from the start, I agree. This is as much a crisis of policy coordination as it is a debt crisis. You now get downgraded because your country or your area is being run in a shambolic way. The next one is from the United States, and it's Clive Crook who's over there at the moment giving us Obama's failed debt ceiling gamble. Amid disturbing signs that the US recovery has stalled, President Barack Obama took a huge gamble in his approach to the debt ceiling talks last week. Believing he had an understanding with John Boehner, leader of the Republicans in the House of Representatives, he declared he wanted a great $4 trillion grand bargain on the budget. But barely a day later, Boehner said the deal was off. And by Sunday evening, with talks about to resume at the White House, the president's gambit appeared to have failed. So those are the two main problems, which are Europe and its incompetent handling of the debt crisis, and the American politicians' incompetent handling of their economic crisis, from which we go over to the article in China, which was also linked in Pink Pics, by Lex. China's shadow banks hunt the risks. It was not the shadow banks that brought the US economy to its knees. The deleveraging of all manner of non-bank investment conduits, vehicles and structures certainly magnified the impact of falling house prices and globalized the crisis. But the core of the problem was the same as in every other banking crisis: sloppy underwriting. At mainstream lenders. For the US, read China. The latest data showing a widening trade surplus while consumer inflation rises to 6.4% raise further the concerns about overheating, but despite angst over its shadow banking system, the big risks are probably embedded in the real one, in the real Chinese banking system. The article goes on to explain that, well, we know roughly of the overlending that has gone on. The Chinese government said, stop that lending, it's getting out of control. So the banks have then gone to intermediation between private lenders and private borrowers, and now a huge amount of business is just being intermediated through the banks and straight out, which isn't being put on the bank's books as lending, but it is transferring debts from the haves to the want-to-borrows, and that is It's seemingly the Chinese government cannot stop the mad turning round of money, and certainly can't control where it's going. So that's the third of our problems: Europe, America and China. FT Alphaville, back in Europe, we're going to finish with what keeps an EU finance minister awake at night? The upward trend in Italian government bonds, of course. And this is the chart. You can see in quarter 1 and quarter 2 of 2011, it was going along quite nicely at 4.7, but has recently started shooting its way up. And as the article goes on to say, what happened in Greece, Ireland and Portugal was they were very slow getting above 5, but it took this much time to get to 5.5. It took this much time, much less, to get to 6. It took this much time to get to 6.5, and nearly no time at all to get from 6.5 to 7. As you get above 5 and head towards 7, everything seems to accelerate. Bloomberg: Italy hurt by irrational speculation, Hoyer tells La Stampa. Italy was the victim of irrational speculation in the financial markets last week, Germany Deputy Foreign Minister Werner Hoyer told La Stampa, saying the country can balance the budget by 2014 and its banks are sound. Italy approved an adjustment plan which will now be debated in Parliament, Hoyer said in an interview, and basically trying to say everything is fine, so you know it definitely isn't. I've dragged this old article out of Gollum because I know that I mentioned it on a World Economic News, 16th of December 2010, UniCredit, another Lehman Brothers. People have known for a long time what was going on. It is a strange thing. This was back in this article at that time. All yesterday's attacks on democracy in Ireland and Greece and worries about state sovereignty in those countries, as well as Portugal and Spain, that it was Italy's largest bank which suffered a very large fall in share price, the largest of any bank on that day, I think. UniCredit lost 4.2% of its share price in one day, taking it down to just $1.63 a share. So we look at the chart today, and it's languishing down in the 120s. And you can see that the blob in December, three quarters of the way across, was one of its dips down. It struggled up and dipped down again. Seemed to have regained footing by March, but you can see since March has been on a nasty little slide down, with the whole of the trend from October 2009 is very much down. UniCredit. Finish with the Telegraph because Ambrose Evans Pritchard is back from his sabbatical. I think he went to South America actually. And his wonderful brain and absolutely shockingly bad writing is back in the Telegraph again. Italy and Spain must pray for a miracle. Once again, Europe's debt crisis has metasized, and once again the financial authorities face systemic contagion unless they take immediate and dramatic action. Welcome back, AEP. From the article we read, fallout from Greece flattened Portugal and Ireland last week. It is engulfing Spain and Italy, countries with 6.3 trillion of public and private debt between them. 6.3 trillion. It's amazing what big numbers you can get to when you total it all up. Yields on Italian 10-year bonds hit a post-EMU high of 5.3% on Friday. This is not just a theoretical price. The Italian Treasury has to roll over 70 billion euro in August and September of this year, and it must tap the markets for 500 billion euro. That's €500 billion before the end of 2013. End of 2013 is a long way, but €500 billion when the market doesn't like your country is a very, very big number. The interest burden on Italy's 1.84 trillion euro stock of debt is about to rise very fast. Later in the article, Italy's Premier Silvio Berlusconi has chosen this moment of acute danger to undermine his own finance minister, well-respected the finance minister, Giulio Tremonti, the one figure in his cabinet respected by global bond vigilantes. He's not a team player, and he thinks he's a genius and everybody else is a cretin, said Mr. Berlusconi, charmingly. Meanwhile, Tremonti is living free in the Rome house of a political ally just arrested on corruption charges. Resignation rumours circulate hourly. You can hear the knives sharpening. It's AEP. Later, we go over to Spain. It will also take a purge of ECB's leadership, which clings to its madcap doctrine that monetary policy can be separated from other emergency operations, and which chose last week of all moments to raise interest rates again and kick Spain in the teeth. I think it just kicked it in the ankle, really, but wait till they get higher. That'll be really getting up to the teeth. It did so knowing that the one-year Euribor rate is used to price more than 90% of Spanish mortgages, which must rise in lockstep. As one Spanish commentator put it, the Euro Tower in Frankfurt should be torn down and salt sown in the ground. I think that means it should be pulled down and never be put back up again. If the governor of the Bank of España really endorsed this rate rise, supposedly which was unanimous, he should be hauled before the elected Cortes and ordered to explain such locura. If the EU authorities object, they should be told in crisp terms that Spain is a great and ancient sovereign nation facing a national emergency and will do as it sees fit. Spain is a great and ancient sovereign nation. It's an ancient sovereign nation. It's been a basket case for just about all its existence, except for a brief 100 years. The rest of the time it's been nothing at all. We finish with, it is almost pointless trying to establish exactly why this latest bout of contagion has erupted. You can blame Moody's for its downgrade of Portugal, or blame Germany's Krieg against private investors for forcing Moody's to act the way it did. The deeper cause lies in the entire machinery of wreckage created by the Maastricht process since the mid-1990s. And AEP has been writing about it since the mid-90s. A full throttle global recovery would mitigate this. Everybody could really do with a full-scale global recovery. But a half-decade of super easy money by the ECB to weaken the overvalued euro and stave off debt deflation would help too. Without either, Italy and Spain can only pray for a miracle. And seeing I was there, we note at the bottom that the spot price of gold in euros has just gone through 1,100 euros an ounce. Bye.